When I talk about the HNI UHNI segment, which is the high net worth individuals or the ultra high net worth individuals in the Indian landscape, we have close to about 8 lakhs HNIs right now, and the number is increasing by more than 10% on a CAGR basis. And I think we would have easily about 1.6 million HNIs by 2027-28. Earlier, when we used to talk about wealth, we used to talk about only three segments, which is wealth creation, wealth preservations, and then wealth transfer. Today, wealth creation per se may or may not be till only 50, 55 or till 60. A 60-year plus, a 70-year guy also would want to participate in the wealth creation story and also would want to simultaneously do a wealth transfer story, which is the succession planning and the transfer of wealth. So, all three are in tandem today. Bajaj Capital has been in the existence for more than 6 decades now. We just celebrated our 60 years of existence. We are a wealth firm. We have presence in almost 300 locations. Almost 60 to 70% of the India's pin codes we cater to. And more than 4 million customers, 40 lakh customers are there. When you are catering to a segment which is wealth management and over generations for more than 6 decades, you always feel that there is more that you can offer to the clients, and hence the concept of private wealth came into existence.
Hey everyone, this is Prashant and I'll be host for the VC 10X podcast, and today we have Kalpesh Dave with us. Kalpesh has over 20 years of experience in banking, investments and wealth management. As the Deputy CEO at Bajaj Capital, his focus is on delivering value-added solutions to HNI, UHNI, family offices and NRI clientele. In this episode, we talk about the growing private wealth landscape in India. How many wealthy families are there in India and how fast is that number growing? How the Indian wealthy manage their wealth. How do they build a wealth allocation strategy for their clients? Exciting investment opportunities for wealthy families and lots more. So without wasting any time, let's dive straight in.
This episode is sponsored by my own podcasting agency called Podcast 10X, where I help venture capitalists, asset managers, allocators, and family offices in starting their own podcast and building a strong brand. Podcast 10X is designed in a way to work well with the busy schedule of investors, where we handle every aspect of podcast production so you can focus on investing. If you're looking to build a strong investor brand, starting a podcast should be right up your priority list. It's the only form of marketing where you can showcase your strong network, in other words, access to limited partners and founders, and grow that network further. And contrary to what most people hear, it's still very early to start a podcast. There are at least 10x more newsletters and 1000x more blogs than there are podcasts in this world. You can learn more about our podcasting services at podcast10x.com. I'll make sure to add the link in the description below. Enjoy this episode.
Hey Kalpesh, so good to have you on the VC 10X podcast. How are you doing?
Hi Prashant, it's nice to be here and it's an honor. I've been hearing your podcast quite a bit. It's been a while we spoke, but it's nice that you're here today.
Great, absolutely. Yeah, pleasure having you on. To start things off, can you give us a little brief about Bajaj Capital? What is it? What's its history? And what are the plans with the new private wealth business that started?
Bajaj Capital has been in the existence for more than 6 decades now. We just celebrated our 60 years of existence, and we are a wealth firm. It was started by Mr. K. Bajaj Sahab in 1964, and since then, even Rajiv and Sanjeev has joined the business and expanded it to where it is today. We have presence in almost 300 locations. Almost 60 to 70% of the India's pin codes we cater to. And more than 4 million customers, 40 lakh customers are there, 300 kind of branches or touch points, and more than 5,500 plus employees. So it's turned out to be pretty decent over the last 60 odd years. But when you are catering to a segment which is wealth management and over generations for more than 6 decades, you always feel that there's more that you can offer to the clients, and hence the concept of private wealth came into existence. We are present in the retail space. We are present in the mass affluent space. We were catering already to the space but there was, on the offering side, there was something missing. So we obviously decided to cater to that segment also, get all the product basket in place. This was thought by Rajiv Bajaj, and that's where I came in, and we were expanding the private wealth piece for Bajaj Capital. And the journey is exciting. So far, we've just completed a year. So it's been 60th foundation day for Bajaj Capital. It's been 1 year foundation day for private wealth as well.
Absolutely, that's quite incredible story there. And with the private wealth, I think that's an interesting landscape and expanding landscape, I should say.
Yeah.
How do you look at the private wealth landscape in India?
See, India as a story is pretty interesting now. We've read a lot. A lot has been said already about the India story and how we're going to grow in the next 7 to 8 years. But let's just focus on the next 5 years to be precise. So when I talk about the HNI UHNI segment, which is the high net worth individuals or the ultra high net worth individuals in the Indian landscape, we have close to about 8 lakhs HNIs right now, and the number is increasing by more than 10% on a cracker basis. And I think we would have easily about 1.6 million HNIs by 2027, 28. And there are many various reports that can actually verify the numbers, or maybe give you a better number than what I'm giving. Uh, that kind of growth, that kind of massive growth in the HNI segment itself uh, needs a lot more focus. I feel that there'll be many people, obviously, with a lot of money and with a focus to invest into the markets and make more money. So this landscape per se, when we talk about, is going to explode in the next 4 to 5 years. There are many things that they will require. In fact, if I do a jot down, or probably the bifurcation of the current HNIs also, let's say about the 8 lakh numbers that we have right now, and 20% of them are less than 40 years of age. Earlier, about 2 3 decades ago, or even 1 decade ago, that this was not the case. The HNIs are increasing in that space quite a bit because of the startup, because of the technology, or the IT tech. Um, that money is also flowing in. So I feel the requirements will differ quite a lot. Earlier, when we used to talk about wealth, we used to talk about only three segments, which is wealth creation, wealth preservations, and then wealth transfer, which is for all HNI, UHNI customers. We used to talk about that. Now the wealth creation focus is also changing quite a lot. You find a lot of people who are more than 60 years of age, which used to be under retirement scheme of things, participating actively in the equity space, which earlier used to be not the case. I mean, we wouldn't have seen that aggressively. But today, wealth creation per se may or may not be till only 50, 55 or till 60. A 60-year plus, a 70-year guy also would want to participate in the wealth creation story, and also would want to simultaneously do a wealth transfer story, which is the succession planning and the transfer of wealth. So all three are in tandem today. So I think that is one thing that is changing. With the growing number of HNIs, the requirements will differ quite a lot. So that's an interesting space to be in.
Yes, absolutely. And there are like different criterias that different firms use for, what they call an HNI and what they call an ultra HNI. So, what's that for you? What number is it that they have to be beyond this threshold for us to call them an HNI or ultra HNI?
So I think the $1 million and above is predominantly called as an HNI, and yeah, so that is a space. $1 million to $50 million would be the HNI space, and then above that would be the ultra HNI space, or the family offices, or so on and so forth.
Yeah,
So for us, it is $1 million and above. Yeah.
got it. Awesome. And you mentioned previously in this conversation that how you saw that there was a missing piece in the wealth creation, wealth management space. What exactly was that missing piece, and how are you solving that at Bajaj Capital?
So not necessarily missing piece, but actually we had a clientele that had a certain requirement, and probably those products were not a part of the basket that we were offering. We were offering everything else under the basket, which is mutual fund, PMS, AIFs, but maybe something on the lines of, let's say, global products, or for that matter, even wealth transfer, succession planning, estate planning, trust planning. These were something that were actually offered, or maybe sporadically. Uh, we have actually got them all under one basket now. So for any client, whether it is whichever category it belongs to, uh, all the services are offered right now. So that is one thing that we did, was enhance the product basket, so that we can cater to every requirement of the client, whether it is even tax optimization, whether it is estate plannings, whether it is even to some extent facilitating with their real estate investment decisions, and analyzing that what is better for them, to either move out of the equities, getting into real estate, and something on those lines. So I think that those conversations, rather than just having an investment product to invest in, is the major change than anything else. I think that is what probably people would appreciate as a change for us.
Absolutely, quite interesting. And since you are like almost dealing in all different types of assets, right? Even public equities as well as private and then global assets as well. How do you look at the entire landscape right now? You'd know that how the equity markets are, public markets are in a slump right now. Might change or go anyway by the time the episode is out in about 2 months, but for now they are in a slump. So how are you looking at that? How are the families that you work with looking at that? Are they like panicking about that okay, my investments are going down, move them out of here and maybe put them into real estate or gold or some of the assets, right? So give me an insight into that.
See, I would like to address this by the first statement of Mr. KK Bajaj Saab. Actually, KK Bajaj Saab says that, and you'll find the statement of Mr. KK Bajaj Saab in on almost all our centers and branches also, that manage your client's money as your retired father's money, and because there is no new inflow going to come into that kitty. So you have to manage it with a lot of care. So that is the first ethics that probably we want to build on and will want to continue as a legacy. Having said that, ah, India is a very, very good story. When I say India itself is a very good story, that means, and India as an economy is going to double. We have been doubling since 1980s, I think every 7, 8 years, and will continue doubling. But now the size is huge. So when such a size of economy doubles, there'll be many companies which will probably be 3 to 4x. It has to happen. If the economy is doubling, there would be certain companies, certain opportunities that would obviously give you slightly better returns than the economy as well. So there are going to be opportunities. There are going to be many opportunities to create wealth, and that's why we are looking at the HNI segment also exploding, and the more money flowing into the hands of the investors or the clients. Uh, Having said that, as I said, India is a growing story. Any correction in the markets, I feel, is a good opportunity to get into the market. And right now, as we see, more and more investors are less than 40 years of age. In fact, whenever there has been a correction in the market for the last at least 2 years, is what I can see, there have been a huge inflow of money coming in and capitalizing on that opportunity. So that is one good observation that we have been having, a good trend that we have been having, very positive for the market also. And that earlier people used to get probably scared of the fact that the markets are correcting quite a bit, but now I think this is predominantly an opportunity as for anyone to participate in the country's growth, and in some large cap at least stocks, wherein you can see that if there is a correction, and there's probably the right time to add up to your portfolios or add up to your SIPs. So I think it has been seen positively. Any correction in the market, I would see it positively. We are a very good story for the next 5 to 7 years. I would want to continue to build on the India story.
Absolutely. And how are families reacting to that? And what's your approach in helping families manage their assets? How are you trying to help them approach this? That should they like take advantage of this kind of slump in the equity markets and put more money there? Or is it more like, or maybe go to other assets that are also providing good valuations and appreciation? So, yeah.
So let me answer this in two segments. First is, as I said, the investment thought process is also changing. When I say thought process is changing, I gave you an example. amount is getting invested when there is a correction in the market, which is again a very, very positive sign. Second is the product segment itself. You probably wouldn't have found so many investors investing into a PMS or an AIF kind of a product, alternate investments products, a PMS product, a real estate related AIF also, or real estate related products also in bits right now, or REITs, you know, um, or ESG as a concept, maybe 10-15 years down the line, you wouldn't have seen it at that point in time, 15 years back. But 10-15 years down the line, you would see it very commonly. In today, most of the HNIs will have an AIF, will have a PMS in the portfolio. Will probably have some other assets, or probably will also have focus on the ESG related segments. So that is the first part, which is the thought process of investment, and the product basket of investment is increasing, and the risk appetite is also increasing technically, because that's where, when there's a correction, they participate in the market. The second point is, when this is happening as a wealth firm, because the trends are changing with the customers. So as a wealth firm, you're supposed to be more prudent and more risk averse as well. So it's an added responsibility for us to get into more research orientation and provide whatever is best according to us for the clients. So the first aspect that we should stick on to, while everybody gets very excited about making money, is the asset allocation. I'll go back to the age old theory of always maintaining your asset allocation, and that's where a good advisor would probably come in. We've seen global markets giving very good returns. We've seen so not necessarily all the money should be in India for that matter, and we can obviously have some 20-25% outside India. Asset allocation plays a huge importance when there is euphoria to create money, and when also there is a downside in the economy. So as you mentioned that the last 4-5 months has been down, you see a gold probably would again rise, and at an overall portfolio allocation level, you would still end up not making the kind of losses that you would otherwise make had all your assets would be into the equity markets only. So for me as an advisor, the most important aspect that you add as a value to the client is sticking to the asset allocation theory. And as I keep on saying that, there's only one portfolio management theory that has got a Nobel Prize, and that is Harry Markovitz's theory, which actually focuses on optimum amount of risks to be taken for the optimum maximum returns that you can get out of that risk. So your risk and returns has to be kind of measured perfectly, and which obviously happens when you get into a proper asset allocation. So my two bits to that is, stick to the asset allocation. Even for the financial advisors, is reassess your asset allocation if required, but stick to a proper asset allocation.
Absolutely. To double click on asset allocation, what are the key components of allocation that should be kept in mind while constructing an asset allocation strategy that is resilient to such slumps in a particular asset class?
Very frank, it completely depends upon the clientele. It depends. I have clients who are 90 years plus clientele, but they still would want to invest aggressively into not just equity but even in the unlisted space. Unlisted space, by the way, is growing quite a lot. 15-20 years back, you wouldn't have heard about people investing into that, but now it is, with HNI, UHNI, it is pretty common to invest into unlisted space. Yeah. So I think, and I have a 90-year-old client also who is pretty much interested in investing into unlisted space. Uh, I would have probably, in my own journey in the last 2 decades plus, I wouldn't have thought about it 10-15 years ago, but today it is very much a reality. So it is very customized to the individual. What is the risk profile that, going back to the very basic of finance and of investments actually, is that, what is the risk profile that the customer is belongs to, and then what is he willing to take as a risk. So investments technically has to be very customized to either a family level or at least the individual level,
Yep.
on the risk appetite for sure.
Yeah, I completely agree on that. What I mean to ask is, of course, the risk appetite is different, and they would probably want to invest in or have favoritism towards some asset class over the others. So that's there. But like as an asset manager, if you're giving generic advice to people or our listeners about what are the key aspects of asset allocation that need to be taken care of, it can be that okay, risk profile is one aspect that needs to be taken care of, right? The other is diversification, and then within diversification, what kind of diversification, right? So that general advice is what I'm looking for.
Okay. So I'll give you some of my do's and don'ts. May or may not be necessarily for the industry per se or Bajaj Capital's point of view per se. For every client, you should have clear do's and don'ts, what you can do or should do, or what you shouldn't do per se. During your net worth calculations, or for that matter, your investment asset calculation, um, as a don't, I would suggest don't count your real estate asset as especially the one that you're staying in, because you're consuming it, as your net worth calculation. Count it as an investment, count it separate to that as your investment surplus. So your risk appetite has to be assessed basis excluding that, not that I'm technically doing 10 crores, out of which 5 crores is my house, and I'm putting in 10% of the total net worth into a particular product. Then technically you're doing it wrong. So logically, if you have a 5 crore house, and if you have 5 crores of investment surplus, and you're looking at 10% of investment to one particular category of asset, then it should be about 50 lakhs and not about a crore. So just a very simple example for this. There is a lot more that can be done. But first is, um, the house that you're staying in should not be included in your investment surplus for any investment related decisions that you're doing. Second is, usually people, um, you have to be very clear about insurance and investments, especially with 60 years plus as a segment. Most of the time, we've seen that people who are about 3 to 4, 5 crores in that segment. Preservation is also very, very crucial. So when I talk about preservation, insurance becomes a very important component. We have heard this many a times that you are just one medical emergency away from being losing all the wealth that you've created for the last 60 years. It usually happens. So insurance, health, life has to be very discreetly followed. Some of the guys would probably include investments and insurance, but that depends upon the individual, the client specifically. For me, a clear don't is, investments are investments, insurance is insurance. You should and must have an insurance, but they both are different asset classes. So you should have it to preserve your wealth, but not to kind of do investments with it at all. But again, it totally depends upon the individuals. Some of the do's and don'ts would be like this.
Surely. Yeah. And as a caveat for our listeners who might be listening outside India, some of this advice might be India specific. So not all of this
Yes.
will hold
Uh,
if you're in the US or somewhere else, right?
Absolutely.
Great. So, family offices or wealthy families, what are they excited about right now? It can be an asset class, a space, industry, whatever.
See, I think more or less everybody wants a good advisor, uh, who can navigate the market properly. As of date, there is no dearth of information, which used to be when we started our careers about 2 decades ago. There was dearth of information. There were tips going around. There were calls going around to people that, this is a good stock and all that. You don't need all of that right now. You have 24/7, on the screen, which is about equity markets, at least 4 to 5 channels who are covering it up. So there is no dearth of information. In fact, there is excess of information. The issue is about access of information. What is relevant to you out of all of this information is what your advisor is supposed to or do. Uh, get you the relevant information according to your investments and according to what would impact you as an individual. So I think that's where the financial advisor actually plays a larger role. Again, having said that, I said asset allocation again is very important. Global assets has to be there. I genuinely believe there are many markets who can give you who can give you returns, better returns also, and better portfolio allocation to your portfolio, better diversification to your portfolio. So you should have 20-25% maybe into that, 10
Right.
15% maybe into direct equities, large caps. You should have some good debt. Right now, debt is doing pretty well. And any rate cuts, again, debt is going to help. So debt has to be there as a part of the portfolio. Gold is doing pretty well. So gold, again, with any volatility in the markets, gold gold helps hedge the entire portfolio, so that again becomes very important. Um, but these are, the simpler, at times, what we feel is the more complex or the more structured products, or the more complicated products we add into the portfolio, the better the financial advisor is. Actually, that is not the reality. The reality is the simpler the portfolio is, and you are able to get the returns, but simplifying your portfolio, I think that is more important. So, as an advisor, trying to keep your clients' portfolio as simple as possible for them to understand what they've invested into, and then still achieve what they want to achieve, is is where the task lies.
Right, absolutely, quite interesting. And to double click on global assets, right, and investing from India, right, an Indian wealthy family wanting to invest in global assets, what that would look like. One, from what are the kind of assets that are out there that they can look at, both public and private, uh, as well as what will be the legal and taxation framework for that.
Okay. See, the best advantage that we've got right now, I think, is the gift city. People, wealthy families used to set up uh, outside India in Dubai, DIFC, or Singapore, a family office setup. Right now, you can do that probably at much lower cost than what you would otherwise incur setting up your own family office, maybe in Dubai or Singapore. You can do it at a much lesser cost in Gift City. Gift City also provides more than 10 years of tax holiday, which is again very, very good. Uh, I think that opens up you to the entire world. You can set up something there and then invest money through that to world over. Why it should be done technically is because, as I said, there are markets, there are various markets, and you will get opportunities across markets. You will get new products also. There are many products that technically are only available outside. For example, ESG focus that is there outside India. Currently in India, the ESG focus is not as much as it probably would be outside India. Some of the clients would want to invest into digital assets, the cryptocurrencies and the likes. Even those are available outside India to invest in. Plus, or maybe as simple as some people investing into some of the index markets across the world, maybe a eurozone, maybe China as a market, or S&P or Nasdaq. So I think diversifying, one, is very important. Second, right now you have many options to do it. One obviously was your 2.5 lakhs LRS scheme, wherein you could obviously invest into outside markets. But now it is much more structured with Gift City coming in. So I think Gift City is something that one should look at. There are various other options also. DIFC in Singapore also are there. But I would recommend one to every UHNI at least to look at Gift City as an option for sure, as a vehicle from where you can invest into the outside world.
Yeah, absolutely, quite interesting. How do you go about sourcing high quality deals for your clients?
So the expectation of a client, as I said, on a broader level, is you understand the market pretty well. You should understand the market pretty well. You should be able to give me relevant information pertaining to me or my risk appetite or my asset classes that I want to invest in. That is one. Second, you should be in a position to get me some good deals also. I mean, if there are in the markets. I'll give you an example. Like for one of the companies, I wouldn't want to name it, but one of the companies uh, was pretty much traded very well in the unlisted space, was also traded pretty well at the pre-IPO stage, and then got into an IPO about 2.5 years ago. And post the IPO, it saw some upside, and then almost 50% of the depreciation. So it would have probably come to about 40-50 rupees, and then moved on from there to as good as 300. So you saw the journey of that company technically, from the unlisted space to the pre-IPO space to the IPO space, and then post-IPO also there was a journey that was done. Um, Now it probably would have got into the Nifty 50. There's a huge debate that keeps on happening whether one should invest into passives or active. Now that probably company, let's suppose, has got into Nifty. The whole journey of A larger chunk of the journey of wealth creation is kind of happened. Henceforth, also probably a 20%, 25% might happen, or even larger might happen. But a chunk of the journey is already happened, with this company, for example. So you would want to talk to your clients, and make them participate in a journey wherein even at the small cap stage or at an IPO stage or a pre-IPO stage, depending again on the risk appetite of your clients, at what stage would you want them to participate in this journey? Passives are again a good option, but by the time you've done into passives, by the time you've come and invested in Nifty and the company has come into Nifty, a whole lot of wealth creation journey has already been done by that company. So you probably might, you're lucky, you might see again better options or better returns post that, but a larger chunk has already happened. So what a client expects from a advisor is to understand and suggest certain amount of these journeys that he can participate at what various stage basis his risk appetite. They're an IPO stage. I've seen some of the people being very risk averse towards equity only, direct equity only, which I don't think is right. They would probably give the best of the products in the mutual fund or the PMS or the AF or structured products or even for that matter, private credit funds or private equity funds. But probably not direct equity. I see direct equity is also very, very crucial. So um, across segment, you have to advise your clients. Any deals that I say when we talk about deals, the deals could be anything that is, there is in the listed space also. If you see that there's a good space, good correction happen, or a good opportunity, you should be able to suggest to the clients. So your portfolio or your client should be getting access to everything that you can provide, as far as investments are concerned, whether it is debt, whether it is equity, or direct equities, or even on the unlisted space. So I think that is what is expected by a client from a financial advisor.
Absolutely. What are some common mistakes you see wealthy families make while managing their wealth?
So I had been a part of one of the surveys. I guess about 5-6 years ago, we did a survey wherein we saw some of the clientele segment of clients been missold some products, and when we get into more details, we got to know that there are three segments of clients which actually got missold a lot of products by, maybe those products may not be completely wrong for them, but they probably were not pitched in the right way to those clients. So this was generic survey. So we found that CXOs, corporate guys more than 60 years of age, and NRIs. These are three segments which are actually been missold or probably not been given the right information about the right products that have been actually been given to them as an allocation. So I think my two bits to it is one clear segment. Is that any product or any idea or any deal that you're giving to your clients, or you're sharing with your client, uh, you should understand that client has your buying in it or has his buying in it. He understands where you're investing. That is the first most important aspect. As an advisor also, and as a client also, if I'm investing my money, I think one of the biggest mistakes that clients are doing, or even advisors, both guys are doing, is they're not taking the buying of the client, when they're doing an investment. That is the first thing that I've noticed. And the second is, even now, at this age and time also, I've seen the family is not aware where the money is getting invested. So as a client, I would say that you should always incorporate any investment decision with the family. Family should be aware where you're investing, wherever the investment is happening. They may have a say, they may not have a say. That is totally up to them. But everybody should be aware in the family, or at least the husband and wife both should be aware that this is where our assets are, this is where our investments are happening. One of the other things that I've seen is this. So yeah, one or two things is, as I said, keeping the portfolio simple, investing into something that you understand that you're investing in, and second is involving your family members. So I think these are the two major things that I have seen at least in the last 20 plus years of my career, that some people have missed out on that, on the client side as well as I said, from the advisor side.
Right. Absolutely. This now moving to the last question before we try to wrap this up. What has been your biggest learning working with wealthy families, ultra HNIs, HNIs over these years?
I think I belong to a generation wherein, most of the HNIs used to be 60 plus, and still a larger chunk of our HNIs, UHNIs are 60 plus. And some of them are CXOs, which are retired, and some of them are corporate owners, which are now technically taking a back seat, and the new generation is joining them. Retirement is very, very different for different people. So and as I said, Mr. KK Bajaj Saab's comment also, manage your client's money as your retired father's money. I feel retirement per se is is a lot different than what we think. It has got more psychological impact than what probably we would think, and I think that needs to be addressed by the advisor also. So my biggest learning has been over the last 20 years have been to cater to the need of our clients in a way that uh, mentally they are relaxed while living with you. It is very important. It is more important than even the returns that you're making, because end of the day, what everybody wants is a peace of mind. I just quoted you about Harry Markowa's theory, which is the only theory that has got a Nobel Prize for portfolio management. But somebody asked him that where should he invest his money. One of the I think the waiters or the interview guys, and he said 50% equity, 50% debt, because peace of mind is more important. So it all depends upon what is more crucial. But at a particular age and a particular time, I think when you talk to a client, he should get that trust factor from you that this guy is gonna take care of my interest, and it takes a lot of time to build that. Uh, but spend your time and energy to build that trust with the client, and always ensure that he understands where he's investing with you. Returns may differ a little bit, it will not differ way too much, but I think what will matter is you sticking on with the client for a longer tenure. I still am in touch. In fact, some of the guys had attended my wedding also, the clients that I've been in touch for the last 20 odd years. It's like family now. So that is very important to have a relationship beyond just a transaction relationship. I think most of the HNI, UHNI market understands that pretty well. Um, and that has been my learning also, that retirement, especially retired clients, have a very, very good mindset, and I've seen it in my house also. When my dad got retired, he was a government employee, and when he got retired, it was an impact to him, that oh, now it all of a sudden stick him. But that's something that you can probably help your clients with, and this is beyond the normal investments. It's just to give them more comfort, and just to make them more involved in their investment decision.
Absolutely, completely agree. And yes, I think the advisor's role can be pivotal in that, helping them understand the kind of investments you're making and getting them interested, because they have also more time on their hands, and they kind of feel bored in a way that, okay, I don't have anything to do. But managing investments can be a job in itself, right? If they take interest in that, and if the advisor can, advise them in the right way, that can be an interesting thing that can keep them
Absolutely,
occupied.
Prashant. You
Yeah.
actually said the right thing, that while the most of the guys actually post retirement look for a second innings, a second trial with their hobbies. A lot of people actually have hobbies, and they actually explore those hobbies, and some of them have their skills which they actually use for consulting and other things. But as you rightly said, you just pointed out that this also could be a full-time thing, managing your own investments, in a much better way. This actually is one thought that one should have, that this is my money, this is my investment. I need to probably manage it much better, and should be more invested into it. I've seen a lot of such examples wherein before retirement the guy was not into investments per se, but post retirement, in 5 to 6 years time, he actually is much more knowledgeable than even some of my RMs. so so we've seen these examples quite a lot.
Yeah. Yeah, absolutely. I think that's a great note to wrap this up on. Can you share where can our listeners go and learn more about Bajaj Capital, the wealth management product you have, and where they can connect with you as well?
See, BajajCapital.com is there, and you guys can go through it. We keep on doing a lot of webinars, especially retirement-focused webinars, wherein we give very simple products for retired people, which is very simple do's and don'ts. As I gave you one or two examples, we cover a lot in detail for especially the retirement community. And there are again more webinars happening for the HNI, UHNIs also, which is done by the private wealth team. You will find a lot more material when you meet the RM than on the website. There is an option for you to go there and suggest a call back, and you will get a call back. Meet the guys. As I said, if there is any medical emergency that you have, you will always take a second opinion. But usually people don't do that in investment. You should always take a second opinion. Even if it is suggested by me, you should always go ahead and take a second opinion from somebody and try and understand what investments you are getting into. As I said, knowing what you're investing is more important. So take a second opinion. For as you do it with your normal doctors, you should also do it with your financial doctors. Always before you actually commit yourself. So that is something that I would want you to say. Have a chat with your financial advisor. Do investments. Take a professional help. It's always better. It's not that they are smarter than you or they're better than you, but it's always better that they are looking at that somebody there is looking at an overall scheme of things for you.
Absolutely. I'll make sure to put the link to the website and also your LinkedIn in the show notes below.
Yeah,
Thanks.
please. You can
Yeah,
put in my LinkedIn details also.
surely.
A lot will be covered there. So if anybody can reach out to me directly as well. More than happy to.
Surely. I'll do that. Thanks so much for making time for this, Kalpesh. It was great talking to
Thanks.
you.